one of the downfalls of two-sided bookkeeping is that the very nature of the bookkeeping means that you can move stuff around. You can also move things around from, say, I owe you $1 million. I can change that into $1 million of sales in the stroke of a pen just by debiting my loan account with you and crediting the sales. And that way, in my balance sheet, I show that I don't owe anybody any money and I'm making a lot more than sales. So it works both ways. I can either reduce my expenses and increase my assets, or I can reduce my liabilities and increase my sales. Both of them have the same effect in that at the end of the day, they show more profitability in the company and show the company in a better light as to not having as many liabilities, or alternatively not having or having assets that they don't actually have. A really good example of this was a company I worked for many years ago, where they were creating a new computer program. And it started off that they did everything right, that only the people who worked on the computer program, their salaries were booked towards the actual programming costs. By the end of the project, however, the company needed to make more money. And so what they did is the entire floor that was being used for creating this program was booked to the cost, even though only 1/10 of that floor was being used by them. Everybody on that floor, all of their salaries were booked to the cost of the program, whereas only, again, about 10% of the people were working on the program. And what that had the effect of doing is creating an asset of about $10 million for this computer program, which was in effect only probably worth about $1 million. So what had they done? They deferred expenses of 10 million, created an asset of 10 million, and then were able to amortize that asset of 10 million over 10 years, therefore spreading the expenses over the next 10 years rather than accounting for them all now.
So Dave, is that not just creative accounting? Is that fraud, creative accounting?
Oh, it's most definitely fraud. The reasons are different from me coming up and stealing, going into the checkbook and writing out a check to myself for $100. That's an easy fraud. You can obviously see that I'm benefiting. I get the $100 in my hand. The company loses 100. There's intent. Everything is there for fraud or theft. When you get into financial statement fraud, it's not that easy to define. Because what you have, which is very different, is that you have manipulation of share prices. So should the share be trading at $200 or should it be trading at $150? Well, if you've altered the books to make analyst expectations or to beat analyst expectations, then your share price is likely to rise. If you were reporting the correct numbers, then the price is going to drop. And so if I've got share options in a company, it makes every reason in the world for me to turn around and say, hey, let's just book this in. Share price is going to go up. I'm going to make, all my share options are coming due. I'm then going to sell them and make myself a huge amount of money. And, we'll deal with the consequences 5, 10, 15 years down the line. The other side of it is I might want the company not to be doing so well. So I'm senior management of a company and we're owned by another company and we want to do a management buyout. Well, if I can talk the price down of the company and make us look as if we're not doing so well, then I can buy the company at a much lower rate than what I should be paying for it. So I'm benefiting down the road when I buy the company at getting a lower price. And it's really easy to do that because all I do is, let's say my sales are $1 million, just for want of a better amount, and I'm making, let's say, $200,000 profit on that $1 million a year. Now, if I was to buy the company at that, then the company I'm buying it from might want, let's say, 600,000, 3 times the annual earnings, which is a fairly reasonable number to pay. But I don't want to do that. So I instead say, oh, let me take $100,000 out of sales and put it to an account that we owe, an accounts payable. So I do that, quick journal entry for 100,000. What that means is now my profitability is only 100,000, and my balance sheet isn't looking as good because now I owe 100,000 on the balance sheet. So now, when we have a look at the price, I said to them, yeah, fine, I'm willing to spend 3 times the annual income on buying the company. I'll have it for 300,000. Thank you very much. And I've just made myself 300,000 down the road by being fraudulent. But it's not a direct influence. It's not, I'm committing fraud today because I'm going to get money today. I'm not buying product at an inflated price to get a backhander from the person who's selling it to the company. It's none of those type of things. This is very specific and it's long-ranging.